Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into company filings to find the juicy details no one else tells you about. This time, we're cracking open Intuit's big annual report for their fiscal year ending July 2025, and let's just say it's packed with more numbers than a tax accountant's lunch order. First off, Intuit is a giant in the financial tech world, making tools like TurboTax, QuickBooks, and Credit Karma that millions of people use. Their mission is pretty grand, to power prosperity around the world. So how are they doing on that mission with their latest numbers? Let's talk money. Intuit pulled in a massive $18.8 billion in revenue for fiscal 2025. That's a solid 16% jump from the year before. To put that in perspective, that's like adding over $2.5 billion to their pockets. A huge chunk of that, $11 billion to be exact, comes from their global business solutions. This is where QuickBooks and MailChimp live, helping businesses manage everything from accounting to marketing. This part of the business grew by 16% too, showing that businesses are still relying on Intuit to keep them running. Then there's Credit Karma, which is really flexing its muscles. Revenue there shot up by a whopping 32% to $243 billion. It seems like helping people track their credit scores and find financial products is a booming business. This segment saw significant growth in personal loans, credit cards, and auto insurance, which is where they make their money. Their well-known TurboTax under the consumer segment also saw growth, going up 10% to $4.9 billion. They attribute this to more people buying their premium services and add-ons like TurboTax Live, where you get expert help. It looks like people are willing to pay a bit more for expert assistance when tax season gets complicated. Now, what about profits? Intuit's operating income, which is basically their profit before certain other expenses and taxes, jumped by a very healthy 36% to $4.9 billion. This is a really strong signal that they are managing their costs effectively while growing their top line. And for the shareholders, diluted net income per share climbed 31% to $13.67. This means the actual profit for each share of stock has gone up significantly. It's a good sign for investors, showing the company is making more money for them. Digging a bit into expenses, their total costs and expenses were $13.9 billion. While that sounds like a lot, it's only a 9% increase compared to the 16% revenue growth. This is fantastic because it means they're growing faster than their costs are increasing, which usually leads to better profits. They did spend more on marketing, up by $410 million, which makes sense as they grow. But they also saw a big drop in restructuring expenses, down by over $200 million compared to the previous year. This likely means they're past the major reorganizations and are settling into the more focused growth phase. But it's not all sunshine and rainbows. Intuit faces some serious risks. The competition is fierce, and they're up against everyone from giant tech companies to nimble startups and, yes, even the government. Specifically, they're worried about the IRS potentially offering its own free tax filing software, which could take a big bite out of their TurboTax business. They explicitly mention the IRS exploring ways to expand its free direct filing system and partnering with more states as a significant threat. They're also heavily investing in AI, which is great for innovation, but it comes with its own set of risks. They're concerned about the evolving laws around AI potential misuse and ensuring their AI tools are accurate and fair. Imagine if an AI tax assistant gave you bad advice. That would be a PR nightmare and a legal headache. And then there's cybersecurity. Intuit handles a ton of sensitive personal and financial data. A breach could be devastating. They admit they're a prime target and are constantly upgrading their defenses. But the threat is always there. They mention the growing sophistication of cyber attacks, especially with the rise of AI being used by criminals too, making their job even harder. A really key part of their business model is that customers come back year after year. For their tax products, they rely on people updating their software annually. If customers don't see enough new value, or if competitors offer something compelling, that recurring revenue stream could dry up. Financially, Intuit is in a strong position. They have $4.6 billion in cash equivalents, and investments as of July 2025. This gives them a lot of flexibility for things like buying other companies, investing in new technology, or returning money to shareholders. They generated a very impressive $6.2 billion in cash from operations in fiscal 2025. That's 27% more than the previous year. This means their core business is generating a ton of cash, which is the lifeblood of any successful company. They're also returning a lot of that cash to shareholders. They spent $2.8 billion on repurchasing their own stock in fiscal 2025 and paid out $1.2 billion in dividends. This shows confidence from management in their own stock and a desire to reward investors. They approved another $3.2 billion for future stock buybacks, signaling they plan to continue this strategy. Looking at the income statement proper, beyond revenue, we see that their cost of revenue, meaning the direct cost to deliver their services and products, increased by 11% to $3.8 billion. In $10 was $10. Adel went $100 dollars 22% of that revenue. For product revenue, it was just 3%. This highlights how much of their business is now in high margin services. Their selling and marketing expenses for fiscal 2025 were $5 billion. That's a significant investment. But it's 27% of their total revenue, which is consistent with the previous year. They're spending to acquire customers and keep them engaged, which seems to be working given their revenue growth. On the innovation front, they poured $2.9 billion into research and development, which is 15% of their total revenue. This is down slightly from 17% last year, but still a substantial investment, especially as they heavily focus on integrating AI into their products. Looking at the big picture, Intuit is navigating a really complex financial technology landscape. They're clearly benefiting from their strategy of integrating AI across their platform, driving strong growth in key segments like global business solutions and Credit Karma. The strategy of creating done-for-you experiences by combining AI with human experts appears to be resonating with both businesses and consumers. Their financial health is robust, demonstrated by strong revenue growth, impressive operating income increases, and a healthy cash flow from operations. The substantial investments in stock repurchases and dividends signal management's confidence in the company's future prospects and their commitment to shareholder returns. However, Intuit isn't without its challenges. Intense competition, especially from potential government-provided services in the tax space, poses a significant risk. The ever-present threat of cybersecurity breaches and the evolving regulatory landscape around AI also loom large. Their reliance on customer retention for core products like TurboTax means they need to continually prove their value proposition each year. In my opinion, Intuit is doing a commendable job of adapting to the rapidly changing tech world, particularly with their AI integration. Their diversified business model across consumer finance, business tools, and professional tax software provides some resilience. The growth in Credit Karma is particularly exciting and shows their ability to expand into new profitable areas. While the risks are real, especially concerning competition and data security, their strong financial footing seems to equip them to weather these storms. They're making smart moves, but they'll need to keep innovating and executing flawlessly to maintain their edge. What's your take on Intuit's latest report? Are you using their products, and what do you think about their AI strategy? Let me know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for tuning in, and we'll see you in the next video.